At the close of each fiscal quarter in San Diego, Peregrine Systems sales representatives drove signed software license contracts to the offices of the company's channel partners. These were resellers. They had no end customers waiting for the product. Attached to each contract, held apart from the auditors and never entered into the accounting system, was a separate letter. It promised the reseller could return every unsold license and owed Peregrine nothing until it did. The revenue was booked that night. The side letter went into a drawer. The structural question is this: how does a transaction with no obligation to pay and a guaranteed right of return become recognized revenue on an audited balance sheet? The mechanism at the center of the Peregrine fraud is the distinction between a sale and a consignment. In software revenue accounting, the difference is not cosmetic. It determines whether a dollar can be recognized at all. Under the governing standard at the time, the American Institute of Certified Public Accountants Statement of Position 97-2, Software Revenue Recognition, a company could record revenue from a license only when 4 conditions were met. There had to be persuasive evidence of an arrangement. Delivery had to have occurred. The fee had to be fixed or determinable, and collectability had to be probable. Consider what those conditions do. They separate a genuine sale from an arrangement that merely looks like one. A sale transfers the risks and rewards of ownership to the buyer. The buyer is obligated to pay a fixed amount, and collection of that amount is reasonably assured. A consignment does none of this. In a consignment, the goods sit with a distributor, but the risk remains with the seller. The distributor pays only if and when it sells the product onward. If it does not sell, it returns the goods and owes nothing. The accounting treatment follows the economics. Revenue from a true sale is recognized on delivery. Revenue from a consignment is not recognized at all until the distributor sells to a genuine end user. This is the entire point of SOP 97-2's fixed or determinable and collectability tests. A fee is not fixed if the customer can walk away. Collection is not probable if there's no obligation to pay. Peregrine's arrangements with its resellers were, in economic substance, consignments. The reseller took no risk. It owed nothing unless it found a buyer. It could return everything. Under the standard, no revenue should have been recognized on delivery. Peregrine recognized all of it. The device that made this possible was the side letter, and its function was to keep the consignment terms out of the arrangement the auditors were permitted to see. Now, the architecture. The scheme, as established by the Securities and Exchange Commission's enforcement actions and the related criminal proceedings, operated on a repeating quarterly cycle. It can be reconstructed in steps. Step 1. As a quarter neared its close, Peregrine faced a gap between the revenue analysts expected and the revenue actual end customer demand would produce. To fill it, the company negotiated license agreements with channel partners. These were not orders driven by end-user demand. They existed to generate the paper on which revenue could be booked. Step 2. The reseller signed a license contract stating a fixed fee. On its face, this contract satisfied SOP 97-2. There was persuasive evidence of an arrangement and a fixed fee. Step 3. Alongside the contract, Peregrine executed a separate side agreement. The record establishes that these side letters gave the resellers the right to return unsold product and relieved them of any obligation to pay Peregrine unless and until they resold the software to an end user. Some contained cancellation rights. Some conditioned payment entirely on the reseller's own downstream sales. The side letters negated the fixed fee and negated collectability. They converted every sale into a consignment. Step 4. The side letters were withheld from Peregrine's outside auditors, Arthur Anderson. The auditors saw the license contract. They did not see the letter that gutted it. Peregrine recognized the full contract value as revenue in the quarter of signing. Step 5. The receivables. Because the resellers had no obligation to pay, they did not pay. Peregrine's accounts receivable swelled quarter after quarter with amounts that would never be collected in the ordinary course. This is the structural pressure point of any channel stuffing scheme. Fictitious revenue produces fictitious receivables, and the receivables accumulate on the balance sheet as evidence of the gap between recorded sales and real cash. Step 6. To relieve that pressure, Peregrine disposed of the uncollectible receivables. The SEC's complaint established that the company engaged in what it internally called factoring. Peregrine sold receivables to banks. But because the underlying sales were not real, the receivables did not generate customer payment. When the banks were not paid, Peregrine paid them itself, then recorded the outflow not as a repurchase of bad receivables, but as a normal operating or investing item. The record shows the company also removed aged, uncollectible receivables from its books through improper accounting, disguising the fact that the recorded sales had never converted to cash. Step 7. The scheme compounded. Because each quarter's fabricated revenue set a higher baseline, the next quarter required still more fictitious licensing to show growth. The SEC found that over the course of the fraud, Peregrine materially overstated its revenue in at least 11 consecutive quarters. The Commission's litigation established that the company recorded approximately $509 million in revenue that was later reversed. Roughly a third or more of reported revenue in certain quarters had no economic substance. The org chart is simple by design. At the center, Peregrine's finance and sales leadership. Radiating outward, a set of channel resellers holding product they were never obligated to buy. Beyond them, banks holding receivables that would never self-liquidate. And standing outside the side letter drawer, the auditors, working from a contract file that had been deliberately curated. Which raises the detection question. Peregrine was a NASDAQ-listed company with a Big Five auditor. The fraud ran for years. Why did the verification chain hold up the fiction for so long? Begin with the audit. An external audit is not a fraud investigation. It is designed to obtain reasonable assurance that financial statements are free of material misstatement, and it relies substantially on evidence the company provides. When the arrangement presented to the auditor is a clean license contract and the document that negates it is physically withheld, the ordinary audit procedure does not surface it. Confirmation of receivables is the classic control here. Had the auditors sent independent confirmations directly to the resellers asking whether they in fact owed the stated amounts, the side agreements might have surfaced. The record indicates that the confirmation process did not defeat the scheme, in part because of how the receivables were being churned through factoring and repurchase before they aged into obvious delinquency. This is the structural insight. The factoring was not only a financing tactic, it was a detection countermeasure. By moving receivables off the balance sheet before they became conspicuously old and uncollected, Peregrine suppressed the single metric that most reliably exposes fictitious revenue: the growth of days sales outstanding. An analyst watching receivables balloon relative to sales would eventually ask why customers were not paying. The factoring flattened that signal. For detection to have occurred earlier, one of two things would have had to be true. Either the side letters would have had to enter the auditor's evidence set through direct reseller confirmation or an internal disclosure, or the receivables would have had to be allowed to age on the balance sheet where their non-collection became undeniable. The scheme was engineered to prevent both. The gatekeepers were not merely negligent observers. They were working inside an information environment that had been constructed to defeat their standard procedures. The unraveling followed the arithmetic. A revenue scheme that requires each quarter to exceed the last has no stable state. The gap between recorded revenue and collected cash widens until it cannot be papered over. In early 2002, Peregrine's newly constituted Management and Audit Committee, alerted to accounting irregularities, initiated an internal investigation. On May 6, 2002, the company announced that its audit committee had begun an investigation into potential accounting inaccuracies and that its financial statements should no longer be relied upon. The disclosure identified potentially fraudulent transactions primarily concerning revenue recognition. The restatement that followed established the scale. Peregrine reversed approximately $509 million of previously recognized revenue across the affected periods. On September 20, 2002, Peregrine Systems filed for Chapter 11 bankruptcy protection. The enforcement record followed. The SEC filed civil actions against the company and multiple former officers and employees. The Commission's findings established that Peregrine had engaged in the side letter and channel stuffing scheme, the improper factoring of receivables, and the write-off of uncollectible receivables to disguise the fraud. Several former executives, including senior finance officers, pleaded guilty or were convicted in the parallel criminal proceedings brought by the Department of Justice for securities fraud and related offences. The record shows convictions and guilty pleas from figures across Peregrine's finance and sales functions and from the reseller side of the transactions. The mechanism collapsed the moment the side letters entered the official record. Once the arrangements were understood as consignments rather than sales, $509 million of revenue simply ceased to exist. Nothing had to be recomputed. The transactions had never met the recognition criteria in the first place. What the Peregrine case establishes is narrow and precise. The vulnerability was not a defect in SOP 97.2. The standard correctly required a fixed fee and probable collection, and it correctly excluded consignments. The vulnerability was that the auditor's evidence set was controllable by the audited party. A contract can be shown while its governing side letter is withheld, and the standard audit, absent independent confirmation that defeats concealment, works from what it is given. Peregrine sits within the cluster of frauds that produced the Sarbanes-Oxley Act of 2002, enacted in the same period as the restatement. Section 302 required executive certification of financial statements. Section 404 required management assessment and auditor attestation of internal controls over financial reporting. And the Public Company Accounting Oversight Board was created to inspect the audit firms directly. These provisions do not make a side letter impossible to write. They change who is accountable for the completeness of the record on which revenue rests. The finding is structural. Revenue recognition is only as reliable as the arrangement the recognizing party is willing to disclose in full.